If there's one thing that can be said about the crypto markets, they can be wildly volatile. From all-time highs to 60% dumps, if you've been invested within the last year, you've probably experienced the highs and lows of both. Wouldn't it be nice to have some cryptocurrency exposure without all the volatility? Today, we're talking about stablecoins. Welcome to Crypto Sketch 101. We're the #1 go-to spot for all things crypto, and we're glad you've stopped by. If you love cryptos as much as we do, please give this video a like, and be sure to subscribe to our channel. In today's video, we're talking about stablecoins. What are stablecoins and how do they work? What are the different types? Are there any risks with stablecoins, and what are the most popular ones? We'll answer all these questions and more, so stick around to the end. So what exactly is a stablecoin? Stablecoins are digital currencies that are linked to a stable reserve asset, such as the US dollar or gold. In comparison to unpegged cryptocurrencies like Bitcoin, stablecoins are designed to lessen volatility. They combine the best of both worlds. They can be processed quickly and offer the privacy of payments of cryptocurrencies while also providing the stability of volatility-free fiat currencies. The value of cryptocurrencies such as Bitcoin can change minute by minute. Buyers and sellers can have confidence that the value of their tokens will neither grow nor fall unpredictably in the near future if the asset is linked to a more stable currency in the manner that stablecoins are. Like other cryptocurrencies, stablecoins don't require a bank to be held in, and they're simple to move. The value of stablecoins may be readily transmitted around the world, particularly to regions where the US dollar is difficult to come by or where the local currency is volatile. There are a few different types of stablecoins, but the three most popular ones are fiat collateralized, crypto collateralized, and non-collateralized, or what are sometimes known as algorithmic stablecoins. As the name implies, fiat collateralized stablecoins have a fiat currency reserve, such as the US dollar, on hand as collateral in order to issue a sufficient amount of crypto coins. Other sources of collateral include precious metals like gold and silver, as well as commodities such as oil. However, the majority of today's fiat collateralized stablecoins employ dollar reserves. Independent custodians manage such reserves, which are audited on a regular basis to ensure that the essential compliance is met. TrueUSD and Tether are popular cryptocurrencies that are backed by dollar deposits and have the same value as a single US dollar. The second type of stablecoin, crypto collateralized, are backed by other cryptocurrencies. Because the reserve cryptocurrency may be volatile, these types of stablecoins are over-collateralized, which means that a larger number of cryptocurrency tokens are kept as a reserve for releasing a smaller number of stablecoins. For example, $10,000 in Ether might be retained as reserves for releasing $5,000 in crypto-backed stablecoins, which would account for up to 50% of reserve currency movements. Price stability is improved through more frequent audits and monitoring. Non-collateralized stablecoins don't have any reserves, but they do have a working mechanism to keep the price stable, similar to that of a central bank. Ampleforth, for example, is an Ethereum-based cryptocurrency with a circulating supply that is algorithmically updated. It is an asset that is immune to supply inflation and remains unaffected by the price movements of other cryptocurrencies, particularly Bitcoin. Compared to other types of cryptocurrencies, stablecoins are relatively safe. But that doesn't mean that they are completely free of risks. Here are a few things to keep in mind. Number 1, reserve risk. It's important to make sure that a stablecoin is fully backed by the reserve currencies that they state they are. The issuer should have enough reserves to cover 100% of the stablecoin. Any less could pose a risk. Number 2, security. Stablecoins, like other cryptocurrencies, require storage, whether it's in your own digital wallet or through a broker or exchange. If a trading platform has vulnerabilities or is not secure enough, there can be the risk of losing your stablecoins. Lastly, counterparty risk. Because stablecoins are cryptocurrencies, one would likely assume that they are decentralized. In reality, stablecoin transactions involve multiple parties, including the bank holding the reserves and the entity generating the stablecoin. For the currency to sustain its value, they must be doing the correct things at all times, such as adequate security, reserving, and so on. Investors put a lot of trust into stablecoins. So much so, you may be surprised to learn that 6 of the top 20 cryptocurrencies by market cap are stablecoins. Currently, Tether is the largest of the stablecoins and the third largest cryptocurrency, coming in behind only Bitcoin and Ethereum. It is pegged to the US dollar by maintaining a sum of fiduciary deposits, reserve repo notes, cash, commercial paper and treasury bills. At the time of this video, its market cap comes in at just over $78.3 billion. Next in line is the USD coin. It is also pegged to the US dollar. Every unit of USD coin is backed by $1 in reserve, which is held in a combination of cash and short-term US Treasury bonds. Its market cap is currently around $48 billion. Binance USD is a 1-to-1 USD-backed stablecoin issued by Binance in partnership with Paxos. It aims to meld the stability of the dollar with blockchain technology, and is approved and regulated by the New York State Department of Financial Services. Its current market cap is just above $14 billion. Terra USD comes in next. It is an algorithmic stablecoin of the Terra blockchain. Terra USD promises users a higher level of interest rate accuracy, interchain usage, and scalability. It is a scalable, yield-bearing coin that offers a scalable solution for problems faced by other stablecoin leaders like DAI. Its market cap currently stands around $11 billion. Wrapped Bitcoin is a tokenized version of Bitcoin that runs on the Ethereum blockchain. It is backed by Bitcoin at a 1-to-1 ratio by way of a network of automatically monitored custodians and merchants. They ensure that its price is pegged to Bitcoin at all times. It allows users to transfer liquidity from the Bitcoin and Ethereum networks in an autonomous and decentralized manner. Its market cap is nearly $10 billion. And finally, the DAI stablecoin. DAI is Ethereum-based and soft-pegged to the US dollar and collateralized by a mix of other cryptocurrencies that are deposited into smart contract vaults every time new DAI is minted. Its market cap stands at around $9.8 billion. In keeping in the top 20, it's also worth mentioning Terra. Not to be confused with Terra USD, Terra is a separate asset and is defined as a blockchain protocol that uses fiat-pegged stablecoins to power price-stable global payment systems. As stated in its white paper, Terra combines the price stability and wide adoption of fiat currencies with the censorship resistance of Bitcoin and offers fast and affordable settlements. Its market cap stands at $26.5 billion. And that's all we have for today's video. Hopefully, you've gotten a better understanding of stablecoins, the different types there are, and their ability to soften volatility and add value to a diversified cryptocurrency portfolio. If you enjoyed the video, please give it a like and be sure to subscribe to our channel. Take care for now, and we'll catch you in the next video.